And we're back. We got another one. This episode today is sponsored by Epic Mortgage. Whether you're buying, investing, or refinancing, call Epic today. That's 708-905-5300. Welcome to Epic Lunch and Learn, the show where real estate meets real talk and your lunch break breaks into a master class. I am Dante Royster, mortgage broker, author, and your guide through the maze of money, markets, and mindset. And today I have Vincent Bertocchini and Marissa Hazelwood. Good afternoon.
Good afternoon.
We're going to be discussing today, obviously, what's inside the big, beautiful bill. That's pretty cool. Big, beautiful bill. Of course, I need to be on page one. We're going to go over the big, beautiful bill. We're also going to talk about why mortgage rates are stuck in the sixes and where are they headed. We're also going to talk about a 5-year mortgage rate forecast. We're going to use a little AI to figure that out. And real estate strategies buyers and realtors and homeowners can use right now. So we will do housekeeping notes at about 12:30, about halfway through the program. Just give some updates on that. But right now, Marissa, I'm going to take it to you. Tell me about the big, beautiful bill.
All right, to introduce myself, I'm Marissa Hazel. You can catch me on Facebook, Instagram, and TikTok as Marissa Hazel. I'm a tax accountant, been in the tax industry for over 10 years, also a mortgage loan officer. And let's talk about this big, beautiful bill rolling out in 2025 and to continue to 2029. So it's basically new laws to the tax industry, well, not just the industry, but to the tax laws. Many changes that impact families, housing, your job, and a few other minute tax changes to the laws that's coming forward from 2025 to 2029.
Awesome. I'll turn the page here for you. Now, obviously, everyone can download or they can get a copy if they email you, right, Marissa? What's your email address?
Correct. My email is M Hazelwood at epic.mortgage. I'm sorry, guys. I got so many emails. But if you email me at mhazelwood at epic.mortgage, I will give you a free copy of this guide that we're displaying today.
Awesome. Obviously, we're going to do a little bit of an abbreviation. I know you do presentations yourself. You had a presentation last week even. So definitely worth checking out. But give us some of the highlights as we kind of go through this.
So let's go through the short highlights. As you can see on the screen, there are permanent changes to the Tax Cuts and Job Act rules that were put in place in 2017. A lot of those laws that were put in place back in 2017 are sticking permanently moving forward. We have updates to deduction amounts as the standard deduction is increasing, which helps a lot of us reduce our tax liability, new credits for family, and then there are some new provisions for homeowners and car buyers. So if you're buying a new car in a couple years, it's some new deductions out there for you. And then there's a few future changes that's rolling out in 2026 and beyond.
All right, I'll turn the page. TGJA rules made permanent. What is TCJA? What is that?
So that's the Tax Cut and Job Act. So back in 2017, I believe this was President Trump, and it's him again making all these changes. But back in 2017, he made a lot of cuts to the tax laws that kind of push a lot of people out of being able to deduct a lot of things on our taxes, right? Before 2017, you would hear a lot of people saying, hey, I itemize on my tax return versus taking the standard deduction. But when the TCJA came around, I always get confused with it too. When it came around, it kind of pushed a lot of people out of that window of itemizing. It took a lot of for instance, we used to write off what we purchased for work as a W-2 employee. This act has pushed that out the window. You can no longer write off any expenses in relations to your W-2 job. So that's what this act is pretty much about. They're bringing it back around and making a lot of those changes in 2017 permanent. For instance, the standard deduction is now a permanent thing. They took away exemptions. I know back in 2016, you'll fill out your W-4 and put one exemption for you, one exemption for your kid, and that equaled out to a standard amount that you can deduct from your taxes as a personal exemption for you and your family. That is no longer the case. We no longer have exemptions. We're strictly stuck to the standard deduction, which it does take place for the exemptions. You do get the little credit. They did put the amount in there. However, you no longer have to take personal exemptions for each family member.
I always felt like the tax code overall is basically dictating what they want, us to be as U.S. citizens. And if
Correct.
we just follow those types of guidelines, it can kind of give you a course of success. So to your point, with the tax cut, where I was thinking of teachers, right? Teachers would always buy supplies for their school classrooms and stuff like that, and all that used to be able to be written off. Now that's no longer written off. You really have to be self-employed. So it is encouraging, U.S. citizens to become self-employed. I remember back in the 1920s, 80%, I wasn't born in the 1920s, but the stats say 80% of people back in the 1920s were self-employed, compared to 20% of people working were like W-2 and working for corporations. And I feel like over time that has been inverted, where 80% of people are working for corporations, only 20% of people are self-employed. And these tax changes may increase that number, where more people are going to go out and become self-employed, so they have ability to maneuver and adjust necessaries, because there's more benefits to them if they do so.
Of course, yeah, you can expense more when you're self-employed.
And what about the general deduction changes?
So far as general deductions, we do have an increase for seniors coming. So that's a good thing. If you have a senior in your family, definitely be unaware. It does max out at a certain income limit, which is 150 for next year. So you want to be sure that they're in that maneuvering their income to the bracket that's satisfied and able for them to take all the deductions that's needed. Another thing that's coming about, that the state and local income tax deduction is increasing. A good thing and a bad thing. A good thing is increasing. Bad thing, we don't keep our receipts to take this deduction, so it's really hard. But I would say if you a heavy spender, you buy a lot of assets, you buy a lot of clothes, a lot of anything, food, anything. It's good to keep those receipts, because now in the future we can write up to 40,000 of those state and local income taxes we pay on our goods and services.
All right, worker and self-employed deductions.
This is the best one. This law change was the best they can think of out the whole bill, if you ask me. So moving forward, we have no tax on overtime and tips. So if you get paid overtime pay and you get paid tips, be sure your employer is putting it on your W-2 correctly. They're gonna change the W-2 and have, I would say it's gonna fall in box 12. In box 12, your employer should distinguish how much of that income was your overtime, how much was tips, because moving forward, we can now take a deduction for it, and you don't get tax on that portion.
Got it.
And maybe we're going to get to this. Marissa, let me ask a question. Did they also change the ruling on Social Security taxes? Currently, it's like anything over $26,000 is taxed on Social Security.
It's 25,000, and no, that is still the same.
Thank you.
All right, family and dependent benefits. It went up, right?
It did go up, but let's go back 1 second and talk about this new 1099K rule that was at the bottom. So far moving forward, I know when Cash App came about, all these little payment systems. And I would say Cash App in particular, because I know they were heavy on it for me preparing taxes. But they were sending 1099s for our transactions, whether you were Cash Apping a family member, where you were doing it for business. They really didn't care, right? So you were receiving a 1099, and unfortunately, some people had to put it on there because it was being reported to the IRS. So that is not the case moving forward. You guys should not see any 1099s from Cash App unless you receive more than $20,000 in payments on that platform. So make sure that you limit those payments. If you have family members, friends sending you money through Cash App, just make sure it's under $20,000 so you won't receive that form and won't have to include that income on your tax return. If it's $20,000 or 200 transactions. So just make sure you stay under those limits if you're Cash Apping a lot, to ensure that you don't have to report that income on your tax form.
Is that collectively, or can that be through multiple different Cash Apps, whether that be Venmo, Zelle?
It's individually. So if it's Cash App, it's Venmo, just make sure it's the limit per processing system.
Okay, thank you.
Yeah, that's good information. Next one up, vehicle and home related provisions. That's what we want to hear.
Yes. So let's talk about the vehicle real quick. Something new. We never could deduct the interest on our vehicle loans. So now moving forward, 2025 through 2028, if you purchase a vehicle, you can now deduct the interest up to $10,000. So that is something that can save us and put us back to itemizing, which I am so happy about, because I do have a lot of clients that needs to itemize, or I should say high paid, and need that little extra deductions to get them over the hump. So that's a good thing that's coming about. Far as electronic vehicles, we were getting the credit if you purchase a Tesla or any electronic vehicle. That is no longer the case. If you haven't made that purchase by September 30th of this year, then that credit is no longer available to you after September 30th. So if you're in the market to buy an electronic vehicle, your time is now. Get it done before the 30th so you can ensure you get the extra deduction.
Awesome.
Why do I sense a Tesla rebate coming up in the next 2 weeks here?
Probably so, right? To get them in. I agree with you, Vince. It's probably going to be some type of incentive within the next.
Everyone's going to have a coupon for the next 2 weeks. Come pick it up.
I was thinking about it. I was like, no, I don't want that in my garage. I'm fear of things of going wrong with that.
Yeah.
Future rules.
Future rules. Let's go ahead and talk about that. So one of the future rules I'm just going to discuss quickly. And if you guys want to go in depth into any of this, feel free to reach out to me. Again, I will send you a free copy of this guide. But the one future rule is the Trump child savings accounts. I think that was so awesome, so amazing for them to start off the young generation of America with their own savings account. If your child is already born, they still qualify. You can contribute up to $5,000 of tax deferred money for yourself, and then your employer can contribute $2,500. So your child can have $7,500 sitting in the savings account, accruing interest for their future. Another thing I love about this bill is any child born in 2025 to 2028, the United States is automatically going to start them off with their first $1,000. So any kid that's born 25, 28, it's automatically going to get this account, and the United States going to deposit the first $1,000. You can deposit up to $5,000. Then your employer can assist and deposit up to $2,500. All these accounts will be tax deferred until the child is 18. So a good savings vehicle, or tax savings vehicle, I should say, for you to hide some of that cash that you don't want to pay taxes on.
Interesting stuff. All right. And then I think this is okay. Reporting and deduction thresholds.
Let's talk about the 1099 NEC, non-employer compensation or miscellaneous. So this form looks like it's going to go away if you're not making more than $2,000. So if you're not making more than $2,000, you will not get this form, but that doesn't mean the income doesn't have to be reported. So anything under 2,000, you have to track yourself. Your employer is not required to give you this form going forward if you make less than 2,000, but you still have to report the income. Keep that in mind.
Awesome. And then that's just wrapping it up. No, that's good stuff. Anything else you want to talk about the big, beautiful bill?
That's pretty much it. It is packed with a lot of updates. This is just the tax portion of it. It's many other law changes that's in the bill. I just covered the taxes, but I would say it's something that everyone should read about, learn about before it actually takes place in 2025. As I mentioned, if you have questions about the tax implications, feel free to reach out to me. There's my information on the screen. And then if you want a copy of the guide, feel free to reach out to me and I'll email you a copy.
No, thank you so much. I wrote down some notes just when I was looking this up. So to your, like you said, tax deductions and depreciation, 100% bonus depreciation is restored permanently for assets placed in service. January 20, 2025, December 31st, 2029. Is that, and that coincides with his election time frame, right? Am I right on that?
Yes, it does.
So he's so we got that. Hold on, no, we'll remove that. Okay, perfect. Okay, and then we got the qualified business income deduction is now permanently extended. Some other things. Opportunity zones are permanent with rolling 10-year designations starting in 2027. Estate and gift tax exemptions are permanently set at 15 million individual, 30 million joint, easing the generational wealth transfer. So, I mean, I guess they always view that as like the death tax per se. I think it was like at $1 million. So now he's raised it all the way to 15 million. So that's a huge.
Those are lifetime caps too, right?
Correct.
Section 1031 like-kind exchanges remain untouched, perfect for tax-deferred portfolio shuffling. Immediate expensing now applies to constructing new factories, manufacturing, refinery, agricultural. Lenders can exclude up to 25% of interest income on rural and agricultural real estate loans through 2028. And then it looks like energy incentives are going away, and they're going to be phased out post 2025. So if you're looking for energy credits per se, now is the time to kind of move forward in that regard.
Yes, those are going away after 2025. So if you're trying to make any improvements to your home, now is the time. Buy new windows or, new furnace or whatever needs to be done. Now is the time, because after 2025, you can no longer take credits for home improvements.
And this is important, and that's, go ahead, Vince.
I'm sorry. I was going to say the vehicle one seems to be something that everyone will like in time as you wind up purchasing a car. I know no one wants a new car bill, but at least that's a new write-off.
Yeah.
Or I was trying to think of the person that said that to me this weekend, was like, I don't want an $800, $900 car payment. I don't want a car payment.
Right.
I was thinking the same thing, but
it's crazy, right? We're talking the average car payment is almost $600 a month right now.
Yeah.
Yeah, it's a tough pill to swallow.
Low end, right?
And that's not anything fancy when you factor in a normal interest rate in today's market at like 6%.
No, it's a tough sledding. I mean, used cars are going to be a huge thing. Trying to pay cash for a car or going to an auction sale. You're going to have to get creative even with the car scenarios. Yeah. It's just expensive. very
Yeah.
expensive. But no, what I was trying to say is, I appreciate these moments where we have a platform now where we can discuss these things, because this is what's important. Knowing what, a bill just got passed and how does it affect me? How does it affect us? That's why we do this, versus, who's going to win on Thursday night, Eagles or Cowboys. That's cool. But this is important. This is going to affect your life more ways than one. So we definitely have to, take the time out there. So next up, I wanted to get into why mortgage rates are stuck in the sixes. I thought that would be a good topic to kind of bring up. We got two licensed loan officers here. What insights and what I think right now the 10-year Treasury is roughly about 4.27.
Yeah, it opened up at like 4.3 today with everything going on. Can you hear any background noise on my end? There's a little construction going on. I just want to make sure you guys don't hear it.
Oh, you're good.
Okay, good. Yeah, so 10-year, obviously we went into the holiday weekend. We closed just around 4.2, and then we had a little bit of spike here. Obviously, there was some news regarding the tariffs that kind of caused the market to kind of have a reverse reaction to the positivity that we've had over the course of the last couple weeks. But the 10-year is holding in that range, and let's call that range between 4.5 and 4.25, or 4.2.
Yeah, and just just to give you guys an idea, the 10-year Treasury bond is a great bond to always pay attention to see where rates are. Generally speaking, you're going to see rates always hover about 1.5% to 2% higher than where the 10-year Treasury is. So that can give you a good barometer of, hey, where are mortgage rates going to be? So if if you always pay attention to the 10-year Treasury, then you'll know, hey, 1.5 to 2, just say 2 to keep it simple. That should tell you roughly just where the actual average interest rate is for a mortgage. Okay. So that's a little nugget right there for you guys.
And right now we're sitting at around 2.5 when you do that math and that margin.
Really?
To today's rates, right? We know what the norm's supposed to be, right? We like the 1.5. We definitely want to say, hey, just follow the 10-year and add 1.5 and 12 ins, right?
Man.
You'll have an epic day. Everything will be good, right? But
Correct.
in reality, right now, we're sitting at 2.5, and that's where the problem is.
Correct. And the frustration is on Jerome Powell, right? Jerome Powell is the Fed chairman. His contract ends May of 26. All right. So he is, he can't be fired. He was appointed by our president back in 2016. And then he was, reaffirmed, with Joe Biden. And then, obviously here he is now. So May of 26, he is going to more than likely, I think it's about a 90% chance he is not coming back. But, his whole history from 2016 really to this year had been looking backwards. He would look backwards, and based on backward data, he would determine where rates should be. But his conversations and his talking points this year have been more forward looking, talking about tariffs and wanting to wait and see, this wait and see approach on what will the tariffs do and how will that impact our market, which is fine to do overall. But overall, when you have a track record, a 9-year track record of always looking backwards, and now all of a sudden you want to look forwards.
The game, right?
Yeah. So that's the frustration within the markets.
That pivot's not good, but in the grand scheme of things, he also had a history in rates that was unseen, unprecedented, with rates being as low as they were.
Sure.
So I kind of got to give him a little bit of that balancing act. And while I totally agree, rates need to come down, he's still done a great job of keeping things afloat and consistent.
Probably if you look at the last, Ben Bernanke, I think everyone was probably disappointed with Janet Yellen. She just didn't get it. But I think Ben Bernanke did a solid job, in the 2008 crash.
Sure, absolutely.
And then Jerome Powell has done a good job overall, but just being inconsistent in that 10th year when you've always had a track record, it's frustrating, because it's like, now we're looking forwards.
Right.
Well, because we're trying to predict, and the market wants to be predictable. That's the whole idea of the market. We want to know where it's going.
Nobody likes uncertainty.
Correct.
Right? I want to know what it is today, tomorrow, and the next day.
Correct. And so
I'll let you get going, so we talk on the other topics too, so we put some other knowledge to what we're talking about out there instead of just Dante and Vince throwing it out there.
No, but we do have some questions, so let's answer. And these are about about the Fed and stuff like that. So I appreciate that. Once again, if you have comments, questions, go right into the comment chat. We can get it from. We're streaming live on Facebook, LinkedIn, and YouTube. So we appreciate all your comments, and we'll try to help you as best we can. Let's go here. Do you see the Fed cutting rates anytime soon?
September 17th, 1:20.
That's the time, 1:20 Eastern. Yeah,
I like
will be cut.
We will get a quarter, and for some of us, let's hope we get a half, but we will definitely get a quarter.
Yeah, I think we're at an 80% chance of a 0.25% decrease on September 17th. That is what the economists' expectations are. Now, once again, as we talked about this, and we always want to make sure we're reminding, the new audience that comes in, as well as the audience that's always with us, that, since we already are predicting this rate decrease, we're already seeing the decrease in mortgage interest rates. The federal funds rate has to do with, your car loans, your student loans, your HELOCs. Those are going to be your credit cards. Those are going to receive lower interest rates, come the 17th. But as far as mortgage rates go, we have kind of built in the anticipation of rates being lower. So don't wait until September 17th and be like, hey, Dante, I heard the rates drop. No, the rates have been dropping because we already knew this was coming. So now is the time to move forward on your refinances, on your purchases. Let's get under contract. Let's move forward. Okay.
And one cut doesn't change the mortgage rate. Let's remember that. One is not enough. So remember that in your timing. It's over a 6 to 9 month period where you'll see how consistent additional cuts will bring that down. One other thing on the economic news front, we get jobs numbers on Friday, so pay attention to that. And after Friday, there's no more Fed talk until the 17th or the 16th, should say, because the blackout period starts.
Yep. They've gone around and had their little Jackson Hole, and they've been all, spouting out things. But, yeah, it gets serious on the 17th. Next question is, could rising Treasury yields push rates even higher this year?
Yes.
Of course.
Yeah.
And don't want to just jump to the quick answer, right? But nope, there's nothing to it. You saw it this morning. We went from what I said basically on the 10-year to 4.2 to 4.3 on the very small news of the tariffs aren't going to work out, because that's revenue that we're potentially going to lose. And that's the whole basis of Trump and the tariffs. So can definitely see rates going higher as well.
Yeah, the thing is, straight lines. There are no straight lines in any market. Any index, there's no straight line. So we are projected to go lower. We just don't know when, and there's no straight lines to it. So there might be some knee-jerk reactions that will increase rates for a period of time. But we are going to go lower, but it's just not going to be a straight line. So you have to be mindful of that. How can first-time buyers stay competitive in a 6% rate market?
Good question.
Yeah. What do you say?
Stop waiting on the dream rate. Rates are temporary. The prices are permanent. So no need to wait. Just get it done. Jump in the market. As they say, date the rate and keep pushing.
Yeah, no doubt. I mean, obviously, when we send out pre-approvals, there is no interest rates on those pre-approvals. It's an amount that someone's eligible for. It's a product type and how much money they're putting down. So yes, first-time homebuyers can stay competitive. I mean, obviously the fear that maybe the question is alluding to is, with rates being higher levels than, the last decade, can they qualify for, the purchase price, because prices have been increasing. But we are starting to see some softening across the board in a lot of areas as far as valuations go, because yeah, go ahead.
Because prices are getting too high. I mean, let's just call it what it is, right? I mean, everybody has a stress point at a certain point in time. I'm not paying for that, and we're seeing a lot of sellers just back out from listing houses because they're saying, I'm not getting my price that I want, right?
Yeah.
And at the end of the day, we've said this multiple times. It's not about the rate. When you want to buy a house, it's about the timing of where you're at in your life. It's the right time to buy regardless of what the rate is. We can always reduce the rate when the time's right. you've talked about this before in the past. We can talk about buy downs or different strategies on what to do, right? But, the hardest part about buying a house today is staying aggressive in your search.
I love that. We'll finish on that one. Next one up is, will the big, beautiful bill help or hurt small investors? What do you think, Marissa?
Neither. Investors are similar to those self-employed people we spoke of that has the opportunity to expense basically everything related to your investment. So I think everything is going to stay the same for the investors. You still have that opportunity to deduct anything related to your investment. So it won't help or hurt. However, it may provide opportunity for other areas in your life, but I don't think in that instant it's going to help or hurt.
What do you say, Vince?
To me, regardless of where we stand, this isn't political, but at the end of the day, Trump's pro-business. So wherever you stand on that, it's always going to be favored to the business side of whatever he does. So I can't see it hurting. We might not have growth, but I don't see it being a negative.
And the only thing I'll say is bills generally rewire where money flows.
Mm-hmm.
And so this bill is definitely allowing money to flow for self-employed people, for business owners. And so when you look at bills, you stay objective to what can it do. In this case, if you're self-employed, it can help you. But it's going to just rewire, every bill just rewires how and where money flows. And just pay attention to that. Let's take a quick time out on just some housekeeping notes. Obviously we do want to promote, if you need a blueprint on buying a house, if you need a blueprint or just, hey, a sense of direction, like, hey, they're using words that I'm not understanding, definitely check out the Ultimate Mortgage Guide. Is right behind me. It's available on Amazon. So if you need that blueprint, the Ultimate Mortgage Guide will help you. Also, too, we do have an Epic Spotlight interview currently right now, Kent Nichols. We did an interview with Kent Nichols, who is a CFO of a church. And so it was an interesting kind of look inside a church situation on just how they run business and how they allocate their funds receiving from tithes. So when you have an opportunity right after this show, make sure you check out the Epic Spotlight on the YouTube channel. Epic Spotlight is Kent Nichols, the CFO. Lakeland, oh man, don't quote me. I think it's Lakeland Church. I'll know that tomorrow. And then we have our preferred listings. We got our preferred listings. So let me go over these. Some are gone, Vince. So this is good news.
I know you got one in Georgia. Is that one still on the board?
GA is still here. We got to get this rid of. So we got 2436 Planters Millway in Conyers, Georgia. It's going for $399. It's a 4-bed, 2.5-bath. Contact Angela Pinnell, 404-425-4660. We have 1100 South 3rd Avenue, Maywood, Illinois. This one had a price change to $375. It's a 5-bed, 2-bath. Contact Tamika Bishop, 630-479-6352. We have a 3-bed, 1-bath home, 8228 South LaSalle, Chicago, Illinois. It's going for $250. Contact D'Amico Pope, 808-428-3770. We also have some commercial. Once again, we do commercial lending as well as residential lending. 1413 East End, Chicago Heights. It's a commercial storage. We're going for $165. Contact D'Amico Pope, 808-428-3770. We have 1645 Western Avenue, Chicago Heights. Used to be a Burger King there. Used to also be a title company. Maybe it's the next hookah lounge. Contact Keith Terry, 773-655-1360. My client is selling his house. It's a 3-bed, 2-bath home at 14327 Lincoln Avenue in Dalton, Illinois, going for $225. Contact Evelyn Wood, 773-718-9742. We only have one condo remaining, Vince. It's 6945 South Dorchester Avenue, Unit 2S, Chicago. Contact Evelyn Woods, 773-718-9742. And our latest one is 9049 South Parnell Avenue, Chicago, going for $279,980. Contact Sebastian Kupiec at 773-430-8988.
Let's get those houses sold, man. Otherwise, I'm going to be doing the preferred listing list by memory, and we're going to know which one it is because You use that hookah line a lot. You lose the old title company and the Burger King quite often, and then the follow up with that's a large condo, 3-bedroom, 2-bath. But go ahead, buddy. I appreciate it, man. Remember, make sure you state your website where they can find these properties again.
Perfect. Appreciate that. Yes. So if you want a little bit more detail on those preferred listings, go to www.danteroyster.com. We have a whole section there for preferred listings at www.dante, D-A-N-T-E, Royster, ROYSTER.com. So definitely, that's funny you say that. But no, that condo is under contract now, man. So that big condo is gone. So
there you go.
It is working, ladies and gentlemen. Thank you so much for participating and helping us out. We appreciate you listening to us. And once again, preferred listings mean these are listings that we know the listing agent. So you might have a buying agent out there, but guess what? Sometimes they don't know. I've never heard of this company. I never heard. But if you go there, they've heard of us and they can accept your offer. So you have a good shot if you go to those listings. And we're trying to help everyone get under contract and close on a deal, buy your first home or maybe your first investment property.
And that also goes for new realtors out there. If you want us to put your properties out there, get in touch with us. I mean, we've talked about that stuff. We're here to help you build your referral base as well as ours. So just keep that in mind if you want it added.
Yeah, definitely. I mean, we've worked with real estate agents. We're going to have a real estate agent on Thursday, so that'll be exciting. We're going to talk about some investing with her, Wendy Lee. Wendy Lee is going to be with us on Thursday. We have April Pryor, who's going to be on tomorrow, an attorney, doing some amazing things in the Chicagoland area. She's got a brunch. I forgot to even bring that up, right? She's got a brunch on September 14th. Where's my notes? Yes, April Pryor. She's going to be on tomorrow promoting, but we are going to talk about her home buyers brunch at Morgan Park United Methodist Church on September 14th at 1 o'clock at 11030 South Longwood Drive, Chicago, Illinois. Want to buy a house? Definitely want to attend that home buyers brunch. I'll be there, and I think she's giving me 10 minutes. So I got 10 minutes.
That's not enough for you. You need more than 10 minutes.
That's enough.
Man, you don't know who I am. I'm like, I only get 10 minutes. I got the other people talking. So I'm like, all right.
Yeah, that's it.
All right. Fair enough.
Keep the main thing.
Man.
Keep it to the point, Dante. Just plug the book and bring copies and sign it. You'll be good.
There you go. Yeah, I'll bring some copies of the book and we'll keep it moving. But yeah, I was like, man, 10 minutes, that's all I get? Okay. All right. But she'll be on the show tomorrow. We'll talk about, some of her, just the whys and what she's trying to do to really spread the word about home ownership and buying. So that'll be a good conversation tomorrow. So next up, let's get back to it. We were talking about a 5-year mortgage rate forecast. I was using a little AI this weekend. As I was telling people earlier today, loan officers, we don't really get days off too tough. I mean, you try to unplug, but, people are calling and stuff like that. And I was like, man, do I get a day off? But that's just not what we do. So as far as when I was looking at, just the Treasury, correlations, I was using Yahoo Finance, just the models. It was talking about, probably by the end of this year, mid 6% is right around where we're going to be at. Roughly about 6.5 is a fair range to be around. And it's really just because the Fed are being cautious. Obviously inflation has not gone away. And it's kind of spiked a little bit. I mean, I shouldn't use spike. Maybe that might be too aggressive, but it has been up as of late. So they want to keep an eye on inflation. And then obviously there is that uncertainty on just how the tariffs are going to impact spending, especially around the Christmas holiday that comes up. So that's what they anticipate. In 27, though, they would view, and obviously I'm imagining that we're going to have a new Fed chairman in 27. And so they're talking about a gradual dip into high 5s as supply chains normalize, as we have a new Fed chairman. I imagine the relationship between the new Fed chairman and Trump will be even stronger. And, he will get a little bit more say. And, this is a legacy push for him as well. Try to get rates low so, he can really, say he's done all and accomplish all these amazing things in his time. And so if getting rates in the 5s will drastically change the dynamic of just consumers' behavior. Would you guys agree to that?
Yeah.
Absolutely. I'll let Marissa go first, then I'll throw some stuff out there.
No, go ahead, Vince. You can take it.
You sure?
Yeah, I'm
Okay.
positive.
So, I mean, if we take that 2027 forecast, right? We've talked about this all the time. Life changes. Typically, you sell a house every 7 to 8 years or 7 to 9 years, right? And because of low rates, that stretch has become longer and longer. But then we're hitting that 7-year mark from historically low level interest rates where people are going to need to make the move because of life changes. And then you also have those that have bought the house within the last 3 years that are getting more than a 1% deduction in an interest rate, which is what historically is the magic number of when you're supposed to refi. So you're going to get kind of a blending of, oh, I bought my house in the last 3 years. I can take advantage of lowering my rate by at least a point. And then you're going to get the people off the fence of, well, I'm at 4. I can go to 5.5. I can get the money from my house and I can move on. So we're going to get that mesh of basically the two lanes colliding, which is going to create that environment of activity.
You got something to say, Marissa, you think?
I have nothing to add. He covered it well.
I like, the thing I always want to put it in real life situations. So if you were pregnant and you had a child and, and you're renting right now, you want to, basically purchase a property in order for that, in order to have a house for your baby.
Mhm.
And your focus is to have that house for your baby. Now, fast forward 5 years from then, you're going to be conscious of, where's that baby going to go to school?
Yeah.
So I had a conversation with a client of mine. She bought her first house. She had a little baby boy. He was about 1 or 2 years old. Now, but she's already now, fast forward. Hey, where's my baby going to go to kindergarten? I don't like this school district, or I can tolerate this school district, but man, where's the feeder school? You know what I mean? And so those decisions from a school perspective, 5-year-old, maybe a 13-year-old, so that's that, 5-year interim, that's an 8-year interim, and so that falls into when people, especially if they have families and they have kids, when they have to make those adjustments, when they have to move, because it's like, oh, well, my baby can't go there. I don't want my baby to go to that high school. I want my baby to go to this high school over here. So we need to move into that school district. You don't think about school districts all the time if you have a newborn. But when you have a child that might be 11, 12 years old, now you're a little bit closer, and so that's the thing. It's hard to see into the future. When I say, hey, Marissa, where are you going to be in 30 years from now? It's hard to predict that. What might be more realistic is, hey, where are you going to be tomorrow? Where are you going to be in a week from now? It's a little bit closer to reality. So those are the things. If the rates can work with us, it allows those people to make those decisions that as they would normally make, versus, oh, now I'm staying 10-year interims because the rates are so high, comparatively speaking, that I have to stay longer into a property because I need to put more of a down payment down for that future home, because I'm just trying to keep the payments affordable. But now that's really stretching us out. Now we're using our whole family, right? Where we're using grandma's address to keep the kid to go over there, because it's like, well, I got to stay over here. So we have to do those types of things because these interest rates. So that's how bad, or just reality is, that's how rates really affect our family dynamics, just even from a schooling perspective.
True consumer decision.
100%. All right. We got some more questions here. Keep them coming. Appreciate it. Do you expect lending rules to tighten further in 2025? Quick answer would be no.
To me, correct.
Right now, right?
We don't want to see anything tighter than what we have, right? But,
Correct.
And with that being said, I mean, they're not really restrictive. What makes them restrictive is the standpoint of affordability.
Yeah.
I mean, I will always go back to this. If you're putting 20% down on a property, whether it's commercial, residential, although commercial requires 30, you're putting enough in the property that there is no risk to the lender in today's market, because housing values aren't dropping. So it's kind of hard to say what's that tighten for the future. It's all about the affordability.
Yeah, no, I think to your point, the only thing that we end up seeing a lot of is a situation of, I would say, clients, when they buy homes, are still being evaluated from a respect of, are you making your mortgage payments on time? We have seen an increase in foreclosures. We have seen an increase now in delinquencies. And so that will always forever make it, quote unquote, tighter, because lending will always have to go based on, hey, why did we give this person a loan and now they're late on a mortgage?
True.
So, so that kind of will always change the answer to that question. That question will always get changed based on what is the buyer right now doing. Are they paying their bills on time? Are they not? And I always try to tell buyers too, once you buy your house, you're a homeowner, congratulations. But like, you affect the next generation of buyers. If you're not paying your mortgage on time, that's going to affect them, and it's going to make it tougher on them, because now they're scrutinized. Like, they're looking at every deposit. Hey, where did this money come from? Even our dreaded, as you guys know, post-funding conditions. That's when a deal funds and is done, but we still get notification.
What do you mean they brought $1,000 in cash? Well, here's the picture. Look, there's the clothes. What are you worried about?
Man, so those are situations that, will always forever, so yes, I don't think the vision is that they're going to create a new rule that makes it tougher, but it is those, if we run and continue to run into late payments, people are trying to do, once again, refinance, don't do modifications. Modifications should be the last item that you do. The lender is not your friend. And, I call the lender and they say they're going to do a modification. No, man, I'm your friend. I'm the guy that's trying to help you out, not that lender. That lender, man, get you in a modification that's going to screw you up, man. Stay away from them.
Yeah. So I just want to touch on one thing where those numbers are, you brought up where those numbers are rising. You know why they're rising? Because they're coming off of low numbers, but you're also now taking the pocket of people that bought their home in the last 3 years at current market rates that are having life events of job losses or different things of that nature.
Yeah, no, it's just a thing. So let's go to the next one. Paula, how much influence do global markets have on U.S. mortgage rates? Good question, Paula. I mean, they do. We're a global market. We're a global economy. We're paying attention to what happens in Japan, Bank of Japan, and we care what happens in England. So I don't know what percentage, but it does impact just how we do things here. What do you say, Vince?
Yeah, I was having a little tough one trying to figure that out, because I look at it as it's totally different housing markets from terms of just culturally, right? Like, Europeans don't sell houses. They keep them within the families for years and years and years and years. Canada has their own rules. And so it's very hard for me to really kind of comment on that, other than what goes on in another country can affect us in terms of the global economy. But to me, I would personally think it'd be very minimal into the U.S. housing market. As an example, Colorado has something called portable mortgage. Canada has something called portable mortgages, where they'll actually just transfer the interest rate from one house to the other. Like, we don't have anything like that here in the States.
Awesome. No.
They also have 47% tax rate,
Taxes. Right? Yes, there's that to worry about too. There's no big beautiful bill to help that.
Man.
I was like, woo!
Other than A and a hockey stick, it ain't going any other way.
No, it's like if you make
to be.
if you make $100,000 in Canada, it's like a 47% tax on that. So that's how much. And then if you go up to like 250, it's like 55%. So it's
Illinois and the combination of the federal tax, they're getting pretty close.
Yeah, our highest rate is 37%. So. Combine that with the state.
Combine that with a state tax and everything else that goes with it. Now they want another quarter for every gambling ticket I put in. So it is what it is.
I saw that. That's funny. Justina, what advice would you give homeowners debating whether to sell now? Oh, I like that. And that goes into more strategies of buyers, realtors, and homeowners. So what would you say to that, Vince?
The question there is where you're going and what you're going to do with the gains of what you have, right?
Yeah.
I mean, like, again, it's time to sell. It's time to sell. Yeah, you have to figure out where you're going to go. How can I get my offer approved? How am I going to be that person that gets their contract accepted? But at the end of the day, if it's time to sell, it's time to sell. Kind of goes back to one of those things too, from a real estate standpoint as agent. It's almost time to just reach out to your previous client list and asking like, hey, what are those goals over the next 3 years? Are you thinking of selling or not? Because there is a strategy involved in selling. I mean, we have products that we haven't talked about yet. There's bridge loans out there that allow you to buy the new house without selling the current home. And there's things that are coming to the marketplace that makes a lot of that easier. But again, it's still the consumer's decision.
Yeah, I love the bridge loan for anyone that is trying to upgrade or downsize. If affordability is an issue per se, right? So you're wanting to sell because you see a house that you love and you want to buy it, but you don't have necessarily the funds to buy it just outright. You have the ability with a bridge loan to go ahead and use the equity in your house and allow that to be the down payment necessary to buy a home. And that is a great mechanism, especially for those homeowners right now that, if you're a homeowner out there right now and your house is not ready to be sold, right? You invited the realtor over, realtor comes in, it's like, you got to do this work, you got to clean this up, because there's so many hoarders out there. Yeah. Man, you got so much stuff in these homes and you're going to have to remove this or put it in a pod or something. And so, using the bridge loan, because that gives you a whole year. The bridge loan that we offer gives you a whole year to sell your house. And there is no mortgage payment with that bridge loan. And that's what's so effective to it. It's no mortgage payment on a monthly basis. So for anyone that is looking to upgrade or downsize your house and buy a new home, the bridge loan is a key mechanism, and not everyone offers that. We have it here. It's effective. It works. So we highly recommend that you give us a call. Yeah, obviously 708-905-5300. If you are interested in that bridge loan, Realtors, do not, have that in your back pocket. We are your Swiss Army knife in your back pocket. Bring us into action. Let us help you with those clients that need a bridge loan in order to buy the next house. I mean, it's an effective way to be able to get a house that they want to buy bought, and then they can focus on the sale of the house within that year's time. And, normally LTVs are about 70 to 75% loan to value. So obviously we're looking for people that are trying to do this that have been in the house for a little bit of time, right? This is not going to be someone that bought a house in 23 and now they want to sell it. They may not have enough equity in their house. This is going to be someone that's been in the house. Maybe, we're looking at probably, I would say 10 years and longer, and they're ready to go. So it's a great mechanism. We have a lady right now that property's free and clear, but she's a hoarder, just has a lot of stuff in that house, using the bridge loan to go ahead, purchase the new property. And then that way she has a year to sell the house. So bridge loans are huge for this. And to your point, and this is what I always remember you say to me, Vince, and this means a lot to me, is, what's 10% on $1,000? You know what I mean? So 10% on 1,000. Let me do quick math. That's 110.
It's 100. And I know we work with numbers all day long, and I know me and you will talk about this, and maybe at some point we'll do a bridge loan show and show kind of different strategies. Me and Dante have talked about this offline, just in terms of shooting around what's going on. This is a new way of selling your house, is taking a bridge loan. Yes, it's more expensive, but it also creates an environment that leaves you non-contingent potentially for the house you're looking to buy, which brings your offer to the top of the stack in a multiple offer situation. It is a strategy, and everybody has to be involved in making sure it works correctly, but you're not having the stress of, I need to sell my house in order to buy my house. I can't do this until I do that. It cuts all of that out.
Yeah, it's huge. And to the point of the 10% of the 10,000 versus the 10% of 100,000, it's just, kind of re-diversifying or putting yourself in a better market. So, if you're living in a particular area, selling that house and moving into a better area, it'll just increase that appreciation more, and that will help you maybe for retirement's sake when you finally will downsize.
Correct.
We look at that situation of, a first-time home buyer, you're buying a house, and obviously some of the ideologies, we had the conversation with that Will Gales, and he was a Gen Zer talking about, hey, we're looking at forever homes. They want to buy these houses just because of the cost of them, right? So it's taking them a little bit longer to buy, and they're buying a forever house versus a starter up home, maybe the Gen Xers we're thinking of. But needless to say, is once you get the house, there might be reasons why you need to upgrade, because it's hard to project things when you're only a single person, single lady, single male. It's hard to project, like, well, how many kids am I going to have? Am I going to have one kid? Am I going to have two kids? You know what I mean? But so that's the reason for the upgrade. But that downsize, you will really want to capitalize on the downsize where you're not taking all that money from the sale, into the house. If you could take some of it and stash it away in your portfolio, I think that's important too. So, positioning yourself into a better neighborhood where you can see bigger growth and appreciation in time will do you wonders.
Yep. Buy now, save later. Buy the house now, save later by lowering the rate.
Yeah. So as we start to wind down, a couple things I wrote down, and Marissa, you brought up the point, marry the house, date the rate. I think that's a great idea. You definitely want to do that. There are more sellers in the marketplace than buyers right now. I think it's like 3-1 right now, which is kind of, it's just amazing how that kind of, happen over time. But, with those values continue to tick up and up, eventually they got to a threshold where affordability became a play. And it's like, hey, I just can't afford this. And so now buyers have retracted, and now there's more sellers than buyers right now. So to that point, negotiate the seller credits for temporary buy down solutions or closing costs. Don't be afraid to ask, every time. Sometimes realtors are scared to even ask for seller credits because they are so used to the time of that would eliminate your client's, ability to get that property, right? You put a bid in and you ask for $5,000 in seller credits, and they're like, oh, kick rocks, because we have 10 other offers that are not asking for anything. But now it's inverted. Now it's okay to ask.
Yep.
Yeah, you know what? I need 5,000 to close. And they're going to have to come off their high horse right now and work with us to try to get that done. So don't be afraid of that. And then, the HELOCs as well. We offer HELOCs here, and so we need to, try to make sure that people are utilizing HELOCs to get the cash out. Not only just to pay off debt. That's great. You're going to save money there, but that's short term. Long term, where can we take that money out? Take the money out of your walls, and then look to put that, into an investment. Got to see that. We had some great success earlier this year. People taking lines of credit out and buying buildings, buying cash flow opportunities. We got to see more of that, because if there is a softening in the appraisals, that means all this evaluation that you thought you had, it's non-intrinsic if you don't use it.
Yeah.
So you got to use it.
I mean, I've said this before, right? True value of the house is when someone's willing to pay you for it, and you can't borrow more than 80% unless you do a 10% second up to 90. At the end of the day, there's still a hedge in there, meaning there's still 10% of what is the projected value of your home just sitting there, not doing anything for you.
Exactly. So, we wanted to make sure, I thought this was a great show today, talking about the big, beautiful bill, talking about why mortgage rates are stuck right now and where they're headed. Just to finish that idea off, there was even projections, which is amazing. 2028, 2029. Sometimes it's hard to fast forward that far off, but that would be
You'll be 48, 49. Remember,
easy for me. Easy for me. Easy for me. But it talked about potential rates being 4.75 to 5.25 if inflation moderates and global debt stabilizes. I mean, could you imagine? We're back to 4.75 in only, potentially 3 years from now. So, I mean, there's going to be tons of opportunities to refinance, to lower rates. It's just right now, get the properties, get the assets, under contract, get them. So once you have them, opportunities are going to exist right now in this corridor. So let's go around the table and pass out that information, contact information one last time.
Yep, I'll throw mine out there again. Everyone, thanks for listening today. My name is Vince. My Epic email is vince@epic.mortgage. You guys can always reach me at 708-359-8578. I probably won't be back this week. Dante will be hosting the rest of the shows. I'll be back, obviously, Monday and Tuesday of next week for sure. Thank you again for listening, and have a good afternoon.
Marissa?
It was a pleasure to be on the show today. You guys can reach me at mhazelwood@epic.mortgage, or you can reach me on sales 773-290-9929. And please follow me on all social media platforms, Mortgage by Marissa. That's Facebook, TikTok, and Instagram.
And
that's awesome. Go ahead.
The guy in control over there, how many people we have on the show today?
Man, thanks to the audience, we had 262 people listening to us. So that's awesome.
Right.
And he's got to plug the YouTube channel, like and subscribe. We got to get to 3,000. So please do that.
Epic Spotlight on the YouTube channel. We're trying to get to 3,000, need your help. So tell friends and families about us. It's a great channel. Once again, we offer obviously the live show Monday through Thursday from 12 p.m. to 1 p.m. Central Standard Time. So come with us on the journey tomorrow. We'll be with April Prayer tomorrow, talking some legalities and legal. We got an attorney, so that'll be pretty cool. And then also too, on Thursdays, every Thursday, we have a new Epic Spotlight interview. So we're meeting some new people, some great guests. I did an interview yesterday on Labor Day at 4:00. So be on the lookout. There'll be an interview that'll be coming down the pipe down the road. But yeah, no, we're meeting interesting people. Want to bring it to you, and we're taking a little bit of a turn on the Spotlight interviews. We really spend the time on the show, on the live show, from a homeowner, real estate, mortgage lending kind of platform, but we really kind of pivot a little bit and focus on what you're doing inside the house or business related conversations. So really want to bring a different spin to you. And then obviously Fridays we have my my monologue. I answer a question, try to put a little fun into it, a little spin to it, and hopefully you guys are appreciating that as well. So appreciate everyone listening to us. Have a great epic day. It's time to go back to work.
Okay, everyone have a good afternoon.
All right, take care, buddy.
Marissa. Bye.
Thank you, Marissa.
Have a good one.